Gold is once again sitting at levels that make people uncomfortable, not because gold is doing something new, but because it's reminding the world of something it prefers to forget. That money is only as strong as the trust behind it. And trust, once shaken, is very difficult to fully restore. At first glance, the recent rise in gold looks dramatic. Prices have climbed steadily, breaking previous records, outperforming assets that were once considered untouchable. Equity markets are volatile, bond markets are unstable, currencies are quietly losing purchasing power, and in the background, gold is doing what it has always done during moments of uncertainty. It is absorbing doubt. Many people looking at gold today feel the same tension investors felt in the past. They remember that gold has surged before. They remember how it ended, and they assume that history is about to repeat itself in the same way. But history does not repeat mechanically. It reacts to conditions, and the conditions today are not the same. Gold does not rise because people suddenly love metals. It rises when confidence in systems weakens. It rises when promises feel fragile. It rises when the future becomes harder to price. To understand whether gold is near a peak or still early in a longer cycle, we need to stop thinking in terms of charts and start thinking in terms of behavior. Not trader behavior, government behavior, central bank behavior, and public behavior, because gold is not driven by speculation alone. It is driven by belief. If we go back to the 1970s, we find a world struggling to understand a new financial reality. The Bretton Woods system had collapsed. The US dollar was no longer anchored to gold. Oil prices surged after geopolitical shocks. Inflation spiraled. Purchasing power collapsed. Wages failed to keep up. Savings were quietly destroyed. For the average person, money no longer felt safe. It felt temporary. Gold at that moment became more than a commodity. It became a signal that trust had broken down. As inflation accelerated, gold prices surged. Each new high reinforced the belief that paper money was failing. Investors piled in, not because gold was productive, but because it was permanent. By January 1980, gold reached a price that shocked the world. It felt unstoppable. But what followed was one of the most misunderstood collapses in financial history. Gold did not crash because inflation magically disappeared. It did not crash because the world became stable overnight. Gold crashed because the rules changed. Paul Volcker, the chairman of the Federal Reserve at the time, made a decision that very few leaders today would be willing to make. He chose credibility over comfort. He raised interest rates aggressively, knowing full well it would cause pain. Businesses failed. Unemployment rose. Markets screamed. But something else happened. Money started working again. For the first time in years, holding cash meant something. You could earn real returns without speculation. You could save without watching your purchasing power evaporate. The US dollar regained credibility. And gold, which thrives in the absence of trust, began to fall. The collapse was severe. Over 60% from peak to trough, but it wasn't random. It was logical. Gold had done its job. It protected people when money failed. When money recovered, gold stepped aside. That lesson is critical because it tells us what actually kills gold bull markets. Not high prices, not media hype, not even volatility. Gold falls when discipline returns. Fast forward to the early 2000s and the global financial crisis. Once again, trust evaporated. Banks collapsed under leverage they didn't fully understand. Governments rushed to rescue the system. Central banks created money on a scale never seen before. Gold responded exactly as expected. As fear spread, gold rose. It wasn't speculation. It was insurance. By 2011, gold reached levels that seemed extreme, nearly $2,000 an ounce. Headlines warned of currency collapse. Investors feared inflation would spiral out of control, but the inflation didn't come, at least not in the way people expected. Instead, globalization suppressed wages. Technology reduced costs. Manufacturing capacity exceeded demand. Central banks flooded financial markets with liquidity, but consumer prices remained relatively stable. Over time, confidence returned. Not because the system was perfect, but because it was functioning. The dollar stabilized, markets adjusted, and gold began a slow, grinding decline. This decline lasted years. It wasn't violent. It wasn't emotional. It was patient. Gold fell because the fear that drove it higher gradually faded. Once again, gold didn't fail. It simply became less necessary. These two moments, 1980 and 2011, are often used as warnings today. They are held up as proof that gold always crashes after a big run. But that interpretation misses the deeper truth. Gold does not crash on a schedule. It crashes when confidence returns in a very specific way. That confidence requires three things: positive real interest rates that reward saving, a strong and stable currency that people trust long-term, and political willingness to enforce discipline even when it hurts. Without those conditions, gold doesn't collapse. It fluctuates, it consolidates, it corrects, but it remains relevant. Now look at the world today. Interest rates have risen, but inflation-adjusted returns remain weak. Holding cash still feels risky over long periods. Savers are not truly protected. Debt levels are dramatically higher than in any previous gold peak. Governments are more leveraged, not less. Fiscal deficits are structural, not temporary. Central banks, instead of selling gold, are buying it, quietly, consistently, at record levels. And global confidence in fiat currencies, while not collapsing, is no longer absolute. Trade is diversifying. Reserves are adjusting. Monetary power is slowly fragmenting. This is not 1980. There is no Volcker moment on the horizon. There is no political appetite for the pain required to restore absolute monetary discipline. And that changes everything. Gold can fall from here. It can correct sharply. It can move sideways for long periods, but for a true collapse to occur, the world would need to believe in money again, not just temporarily, but deeply. That belief does not exist right now. And until it does, gold remains exactly where history says it should be during uncertain times, quietly absorbing the doubt that modern systems can no longer fully eliminate. Gold's behavior begins to make much more sense once you stop looking at it as a reaction to headlines and start viewing it as a response to structural pressure, the kind of pressure that builds slowly, invisibly, over years. The kind that doesn't announce itself with crashes or panics, but with accumulation, with imbalance, with quiet fragility. One of the most misunderstood forces behind gold's current strength is debt, not market debt. Not corporate leverage alone, but sovereign debt, the kind that cannot be allowed to fail. In earlier decades, governments had flexibility. Debt levels were low enough that interest rate hikes, while painful, were survivable. Economic contractions could be absorbed. Recessions, though difficult, were part of the cycle. Policy makers could choose discipline without risking systemic collapse. That world no longer exists. Today, government debt in many developed economies has crossed thresholds that fundamentally change how policy works. When debt rises beyond a certain point relative to economic output, interest rates stop being a simple tool. They become a threat. Every percentage point increase in rates now translates into massive increases in debt servicing costs, not over decades, over years, sometimes over months. Governments are no longer adjusting rates to guide growth. They are balancing on a narrow ledge between inflation and insolvency. This is why modern rate hikes feel different. They are hesitant, reactive, often reversed or softened at the first sign of stress. Markets know this. Investors know this. And gold knows this, because gold responds not to what central banks say, but to what they can realistically do. In theory, high inflation should be fought aggressively. In practice, doing so would destabilize bond markets, collapse over-leveraged sectors, and force governments into politically impossible austerity. The choice is no longer between inflation and stability. It is between controlled erosion and sudden fracture. That reality changes how capital behaves. In past cycles, rising rates strengthened currencies and weakened gold. Today, rising rates often signal stress rather than strength. They expose vulnerabilities instead of resolving them. And that alters the psychological equation. Another factor quietly reshaping gold's role is demographics. Aging populations across developed nations are placing enormous strain on social systems. Pension obligation, healthcare costs, and welfare spending are rising just as workforce growth slows. This creates a long-term fiscal imbalance that cannot be fixed with short-term policy adjustments. To maintain social stability, governments must spend. To spend, they must borrow. To borrow sustainably, they must keep rates manageable. This is not a conspiracy. It is arithmetic, and arithmetic does not negotiate. As these pressures build, central banks find themselves trapped between conflicting mandates: price stability on one side, financial stability on the other. Historically, price stability came first. Today, financial stability often wins by necessity. Gold thrives in that gap. Another shift that separates today from previous gold cycles is the behavior of institutions. In earlier decades, gold was primarily a retail hedge, a personal store of value. Central banks held it but largely viewed it as a relic. That perception has changed. Over the past several years, central banks have become consistent buyers of gold. Not because they expect quick gains, but because gold offers something rare in modern finance: neutrality. It does not depend on another country's policies. It carries no default risk. It does not rely on trust between counterparties. In a world where geopolitical relationships are becoming more fragmented, that neutrality matters. Global trade is no longer governed by a single axis of power. Supply chains are being restructured. Strategic resources are being reconsidered. Financial systems are slowly regionalizing. This does not mean globalization is ending. It means it is evolving. And in periods of transition, gold becomes more relevant, not less. Another critical difference between today and past gold peaks lies in public psychology. In previous cycles, fear was acute but temporary. People expected normality to return. They believed in recovery as a default outcome. Today's uncertainty feels different. It is not centered on a single crisis. It is layered. Inflation, debt, geopolitics, technology disruption, demographic shifts, and political polarization all intersect at once. There is no single event to wait out, no clear resolution on the horizon. This creates a persistent low-level anxiety, not panic but caution. And gold performs best in that emotional environment. This does not mean everyone is rushing into gold. In fact, much of the public remains underexposed. Equity markets still dominate attention. Speculative assets still attract capital. Gold's rise has been surprisingly quiet relative to its significance. That quietness is important. When gold becomes a mania, when it dominates headlines and social conversations, when it is purchased out of excitement rather than caution, it approaches danger. That is not the environment we see today. Instead, gold is being accumulated steadily, by institutions, by central banks, by long-term holders, often without fanfare. Corrections will happen, they always do. Gold is not immune to gravity. It responds to liquidity conditions. It reacts to short-term shifts in sentiment. A stronger dollar can pressure it temporarily. Rate expectations can trigger pullbacks, but those moves occur within a broader framework that is fundamentally different from past collapse environments. To trigger a true gold bear market, the world would need to believe that debt is under control, that deficits are shrinking, that real returns are sustainable, and that policymakers are willing to accept economic pain to restore long-term discipline. That belief is absent, and without it, gold's role remains intact. Gold is not predicting collapse. It is reflecting constraint, constraint on policy, constraint on options, constraint on credibility. That is why comparisons to 1980 and 2011, while tempting, are incomplete. Those periods ended not because gold failed, but because trust was rebuilt. Trust is far harder to rebuild in a world that has already crossed certain thresholds. The question now is not whether gold can fall in the short term. It can, and it will. The question is whether the forces that ended previous gold cycles are even possible in today's structure. So far, the answer appears to be no. Gold remains where uncertainty concentrates, not in fear but in realism. Not as a bet against the system, but as a reflection of its limits. And as long as those limits remain, gold will continue to matter. Currency confidence is one of those forces that rarely makes headlines, yet it quietly determines how wealth moves across the world. People often talk about currencies in terms of strength or weakness, but that language misses the deeper issue. What truly matters is credibility. Whether people believe that a currency will hold its value not just tomorrow, but over years and decades. For most of the modern financial era, the US dollar has enjoyed an extraordinary level of trust. It has been the default reserve currency, the primary medium for global trade, and the backbone of international finance. That trust was built over generations, reinforced by economic power, military influence, and political stability. But trust, once established, can still evolve. Today, the dollar is not collapsing. It is not being abandoned. It is still dominant. But its position is no longer uncontested in the way it once was, and that distinction matters. Across the world, countries are slowly diversifying how they conduct trade and hold reserves, not out of ideology but out of prudence. Relying on a single currency, no matter how strong, introduces concentration risk. As geopolitical tensions rise and financial sanctions become more common, that risk becomes harder to ignore. This shift is subtle. It is not a dramatic rejection of the dollar. It is a gradual adjustment at the margins. But history shows that even marginal changes in global flows can have significant long-term effects. Gold benefits from this process not because it replaces currencies, but because it exists outside them. Gold does not compete with the dollar in daily transactions. It does not need to. Its role is different. Gold acts as a neutral reference point, a form of monetary ballast. When confidence in currency systems becomes conditional rather than absolute, gold gains relevance. This is why gold often rises not during crises alone, but during periods of transition, when systems are not failing but changing. Another critical distinction between past gold peaks and the present environment lies in how credibility is communicated. In earlier eras, central banks operated with clearer boundaries. Their mandates were narrower. Their tools were fewer. Their interventions, while impactful, were easier to interpret. Today, monetary policy is far more complex. Central banks are expected to manage inflation, employment, financial stability, asset markets, and political expectations simultaneously. Their balance sheets have expanded dramatically. Their language has become more cautious, more conditional. Markets no longer assume certainty. They price probabilities. That shift has consequences. When central bank guidance feels less definitive, markets seek alternative anchors. Assets that do not depend on policy promises gain appeal. Gold does not require forward guidance. It does not issue statements. It does not change its behavior based on elections or economic forecasts. It simply exists. This does not make gold superior. It makes it predictable in a way modern systems are not. Another factor shaping gold's trajectory is the nature of modern inflation. Inflation today is not driven by a single source. It is not just monetary. It is structural. Supply chains, energy transition, demographic shifts, and geopolitical fragmentation all contribute to cost pressures that are difficult to reverse quickly. This kind of inflation does not respond neatly to interest rate adjustments. Raising rates can cool demand, but it does little to resolve supply-side constraints. That creates a persistent tension between policy intent and economic reality. Gold responds to that tension. It does not need inflation to spiral out of control. It only needs inflation to remain unpredictable, to resist full containment, to linger just enough to erode confidence in long-term purchasing power. At the same time, the psychology of investors has changed. After decades of central bank intervention, markets have grown accustomed to support. Crises are expected to be managed. losses are expected to be mitigated. This creates a paradox. On one hand, it reduces panic. On the other, it increases dependency. Gold thrives in that paradox. It benefits not from fear of collapse but from awareness of limits. The awareness that not every imbalance can be fixed without consequence, that every solution carries trade-offs. This is why gold often performs well even when markets appear calm, because beneath that calm, uncertainty persists. It is also why gold corrections today look different. In past cycles, corrections often marked the beginning of long declines. Today, they tend to be interruptions rather than reversals. Liquidity-driven pullbacks rather than confidence-driven exits. This does not mean gold is immune to downside, but it does suggest that its floor is shaped by forces deeper than short-term sentiment. To understand this distinction, it helps to separate volatility from vulnerability. Volatility is movement. Vulnerability is exposure. Gold can be volatile without being vulnerable. It can fluctuate without losing its role. True vulnerability emerges only when the reasons for holding gold disappear. That would require a world in which currencies offer reliable long-term purchasing power, debt is sustainable, policy is disciplined, and geopolitical relationships are stable. Such a world is possible, but it is not the world we currently inhabit. Instead, we live in a world defined by trade-offs. Stability is maintained but at a cost. Growth is supported but unevenly. Inflation is managed but not eliminated. Confidence exists but conditionally. Gold reflects that reality. It is not screaming that the system will fail. It is quietly acknowledging that the system has boundaries. And until those boundaries expand, until trust is rebuilt not through reassurance but through results, gold remains relevant. This is why attempts to declare the end of gold based solely on price action often fail. They ignore the underlying drivers. They mistake movement for meaning. Gold's story is not written in daily candles. It is written in policy choices, demographic trends, and geopolitical shifts that unfold over years. As those forces continue to evolve, gold will continue to respond, not dramatically, not predictably, but persistently. To understand where gold goes from here, it helps to reverse the question. Instead of asking why gold is strong, ask what would actually make it weak, not temporarily, not for a few weeks or months, but in a sustained structural way. Because gold does not decline simply because prices are high. It declines when the reasons for holding it disappear. That distinction is critical. For gold to enter a prolonged bear market, the world would need to experience a fundamental shift in confidence, not optimism driven by liquidity, not relief rallies after crises, but deep, durable belief that the systems governing money are stable, disciplined, and reliable over the long term. That would require several conditions to exist at the same time. Real interest rates would need to remain meaningfully positive for years, not months. Savers would need to be rewarded consistently for holding cash and bonds. Inflation would need to be not only lower, but predictably controlled. Government debt would need to be stabilized. Deficits would need to shrink not because of temporary growth, but because of deliberate restraint. Spending would need to align with revenue in a way that signals long-term sustainability rather than short-term political convenience. Central banks would need to reduce their balance sheets without destabilizing markets. Liquidity would need to normalize without triggering systemic stress. Financial institutions would need to operate without constant intervention. Currencies would need to regain unquestioned credibility. Not because alternatives are weak, but because trust is strong. Global trade would need to function without fragmentation. Geopolitical tensions would need to ease, not escalate. None of these outcomes are impossible, but achieving all of them simultaneously and sustaining them over time is historically rare. This is why gold cycles tend to end not with a bang, but with a shift in belief. When people stop asking whether money will hold its value and start assuming that it will, gold quietly steps back. Until that happens, gold remains part of the landscape. This does not mean gold will move in a straight line. Long-term relevance does not eliminate short-term movement. In fact, volatility is often a feature of environments where uncertainty is persistent but not explosive. Gold can experience sharp corrections without invalidating its broader role. A stronger dollar, a shift in rate expectations, or temporary risk-on sentiment can all push gold lower. These moves can be uncomfortable. They can test conviction. They can feel like the beginning of something larger. But history shows that in environments like the current one, those moves tend to resolve as adjustments rather than reversals. The difference lies in participation. During true market tops, participation becomes widespread and emotional. Gold becomes a topic of excitement rather than caution. Ownership spreads rapidly among those seeking quick gains rather than protection. That is not what we see today. Despite record prices, gold remains underrepresented in many portfolios. Attention remains focused elsewhere. Risk assets still dominate narratives. Gold's rise has been steady but relatively quiet. That quietness is a signal. It suggests that gold is not being driven by speculation alone, but by allocation, by institutions adjusting risk, by central banks managing exposure, by long-term holders responding to structural conditions rather than short-term trends. This is also why gold behaves differently from assets driven primarily by growth expectations. Gold does not require expansion. It does not depend on productivity gains or earnings growth. It reflects balance rather than momentum. In periods when growth is uneven, policy is constrained, and confidence is conditional, gold occupies a unique space. It is not an expression of fear but of realism. That realism is uncomfortable because it challenges narratives of control. It reminds markets that not every problem has a clean solution, that trade-offs exist. That stability is often maintained through compromise rather than resolution. Gold does not celebrate that reality. It simply exists within it. This perspective helps explain why gold often confuses observers. It rises when markets are calm. It stalls when crises erupt. It corrects when fear peaks. Its movements do not align neatly with headlines because it responds to underlying conditions rather than surface events. When fear becomes acute, gold is often already priced for it. When confidence appears to return, gold does not immediately collapse because that confidence is often fragile. This creates a pattern that feels counterintuitive but is consistent over time. Gold is strongest when uncertainty is normalized, when instability becomes part of the baseline, when systems function but under strain. And that describes the present environment with uncomfortable accuracy. The world is not collapsing, but it is not resetting either. It is adapting, slowly, imperfectly, unevenly. Gold reflects that adaptation. It is not a warning siren, it is a mirror showing the limits of policy, the weight of debt, the complexity of global relationships, and the challenge of maintaining trust in an era of constant intervention. Until those challenges are resolved, not managed, not postponed, but resolved, gold's role remains intact. At some point in the future, the conditions that end this cycle may emerge. Discipline may return. Debt may stabilize. Trust may deepen. When that happens, gold will respond as it always has. It will step back. But until then, gold is not an anomaly. It is not a bubble by default. It is a reflection of the world as it is, not as it hopes to be. And that is why, despite record prices and familiar warnings, gold continues to matter.